Module 11 P/E ratio and value investing. The P/E ratio plays a crucial role in value investing strategies. Value investing is an investment approach that focuses on identifying undervalued stocks trading at prices below their intrinsic value. The P/E ratio is a key valuation metric used by value investors to assess the attractiveness of a stock. Here's how the P/E ratio relates to value investing. Identifying undervalued stocks. Value investors often look for stocks with low P/E ratios as they may indicate that the stock is undervalued by the market. A low P/E ratio suggests that the stock is trading at a lower price relative to its earnings, potentially signaling an opportunity to purchase the stock at a bargain price. Value investors seek stocks with P/E ratios below the industry average or historical average to find undervalued opportunities. Relative valuation. Value investors compare the P/E ratios of different companies within the same industry or sector to identify stocks that are relatively cheaper. They look for companies with lower P/E ratios compared to their competitors, indicating that they may offer better value for the price. By analyzing the P/E ratios of comparable companies, value investors can spot potential undervalued stocks with attractive investment opportunities. Margin of safety. The P/E ratio is a tool for assessing the margin of safety in value investing. A low P/E ratio provides a cushion in case of any future earnings disappointments or adverse market conditions. Value investors seek stocks with low P/E ratios, believing that the market may have overly discounted the company's earnings potential. This margin of safety helps protect against downside risk and potential losses. Fundamental analysis. Value investing emphasizes conducting thorough fundamental analysis of a company, including its financial statements, earnings history, and future earnings potential. The P/E ratio serves as a starting point for this analysis. By comparing the P/E ratio to factors such as earnings growth rates, cash flow, dividends, and book value, value investors gain a holistic understanding of the company's valuation and its intrinsic worth. Long-term perspective. Value investing typically takes a long-term perspective, focusing on the inherent value of a company rather than short-term market fluctuations. The P/E ratio helps value investors assess the company's valuation over a longer horizon. A low P/E ratio suggests that the stock has potential for future price appreciation as the market recognizes its true value. It's important to note that value investing is not solely based on the P/E ratio. Value investors consider multiple factors, including the company's financial health, competitive position, management quality, and overall market conditions. The P/E ratio is used as a starting point to identify potential undervalued stocks, but it should be analyzed alongside other relevant metrics to make well-informed investment decisions. Ultimately, value investing aims to find opportunities where the market has mispriced a stock, and the P/E ratio is a key tool in assessing a stock's relative value and determining if it aligns with the principles of value investing. Identifying undervalued stocks using the P/E ratio requires comparing the P/E ratio of a stock to its intrinsic value or to the P/E ratios of similar companies within the industry. Here are some steps to help you identify undervalued stocks using the P/E ratio. Research the industry. Start by researching the industry in which the stock operates. Understand the industry dynamics, growth prospects, competitive landscape, and any factors that may influence the earnings potential of companies within that industry. Calculate the P/E ratio. Calculate the P/E ratio of the stock you're analyzing by dividing the current stock price by the earnings per share, EPS. The EPS can be obtained from the company's financial statements or financial data sources. Compare to historical average. Compare the current P/E ratio of the stock to its historical average P/E ratio. If the current P/E ratio is significantly lower than the historical average, it may indicate that the stock is undervalued. However, it's essential to consider any significant changes in the company's fundamentals or industry conditions that may have affected the P/E ratio. Compare to industry peers. Compare the P/E ratio of the stock to the P/E ratios of its industry peers. If the stock's P/E ratio is lower than the average P/E ratio of similar companies in the industry, it may suggest that the stock is undervalued relative to its competitors. Assess earnings growth. Evaluate the earnings growth potential of the company. If the company has a low P/E ratio but has a solid track record of earnings growth or has positive growth prospects, it may indicate that the stock is undervalued. Look for signs of sustainable and consistent earnings growth, such as expanding markets, new product offerings, or improving operational efficiency. Consider market sentiment. Consider the market sentiment and investor perception of the company. If the company is facing temporary challenges or negative sentiment due to external factors, it may result in a lower P/E ratio. If you believe the market sentiment is overly pessimistic and the company has the potential to overcome these challenges, it could present an opportunity to invest in an undervalued stock. Conduct further analysis. Utilize other fundamental analysis techniques to validate your findings. Assess the company's financial health, cash flow, debt levels, management quality, competitive advantages, and overall market conditions. The P/E ratio should be considered alongside these factors to gain a comprehensive understanding of the stock's value. It's important to note that the P/E ratio alone should not be the sole determining factor when identifying undervalued stocks. It should be used in conjunction with other financial metrics and qualitative analysis to make well-informed investment decisions. Additionally, it's recommended to seek the advice of a financial professional or conduct thorough research before making any investment decisions. Constructing a value-focused portfolio using the P/E ratio as a primary metric involves selecting stocks that are considered undervalued based on their P/E ratios. Here are some techniques for building such a portfolio. Identify a universe of stocks. Start by identifying a universe of stocks that you want to analyze for potential inclusion in your value-focused portfolio. This universe can be based on specific sectors, industries, market indices, or any other criteria you deem relevant. Set a P/E ratio threshold. Determine a threshold for the P/E ratio that you consider indicative of value. This threshold will vary depending on your investment strategy, risk tolerance, and market conditions. A lower threshold typically indicates a more conservative value approach. Screen for undervalued stocks. Screen the stocks in your universe based on their P/E ratios. Focus on stocks that have P/E ratios below your predetermined threshold. This screening process will help you identify stocks that are potentially undervalued relative to their earnings. Conduct fundamental analysis. Once you have identified stocks with attractive P/E ratios, conduct thorough fundamental analysis on each stock to ensure they align with your investment criteria. Analyze factors such as earnings growth prospects, financial health, competitive advantages, management quality, and industry dynamics. Assess whether the company's low P/E ratio is justified and if there are any underlying risks or catalysts that could impact its value. Consider other valuation metrics. While the P/E ratio is an essential metric for identifying undervalued stocks, it's advisable to consider other valuation metrics as well. These may include price-to-book ratio, P/B, price-to-sales ratio, P/S, and dividend yield. Using multiple valuation metrics provides a more comprehensive view of a stock's value. Diversify your portfolio. Diversification is crucial to manage risk in any portfolio. Ensure that your value-focused portfolio is adequately diversified across different sectors, industries, and market capitalizations. Diversification helps reduce exposure to specific risks and captures value opportunities across various segments of the market. Monitor and rebalance. Regularly monitor the performance of your portfolio and reassess the P/E ratios of the stocks within it. Over time, as market conditions change and stock prices fluctuate, the attractiveness of certain stocks may change. Rebalance your portfolio periodically by adding or removing stocks based on their updated P/E ratios and fundamental analysis. Consider a margin of safety. Incorporate a margin of safety when selecting stocks for your value-focused portfolio. This means aiming for stocks with P/E ratios significantly below their intrinsic value, providing a cushion against potential downside risks. Seek professional advice. Constructing a value-focused portfolio requires careful analysis and decision-making. If you're new to investing or find it challenging to analyze stocks, consider seeking the advice of a financial professional or utilizing research resources that provide insights into undervalued stocks. Remember, constructing a portfolio based solely on the P/E ratio carries inherent risks. It's important to conduct thorough research. Consider other fundamental factors. and remain updated on market trends and news. Additionally, investing in the stock market involves risk, and past performance is